What if I told you there's a stock on the Singapore Exchange, sitting right now at a 40% discount to the value of its own assets, paying a 7.2% dividend yield, with a former TSMC CEO on the advisory board, and practically nobody is talking about it? Today we're doing a full deep dive on Hotung Investment Holdings. Stay with me. This one is unusual. Welcome back to JC Project Freedom, and this channel is all about building real wealth through informed investing, not hype. Today's company, Hotung Investment Holdings, SGX ticker BLS. 3 numbers you need to hold in your head. Share price, 1 Singapore dollar and 45 cents. Net asset value per share, 2 Singapore dollars and 44 cents. Dividend yield at current price, 7.2%. That a 41% discount to book value, with a yield most people would kill for in this rate environment. Is this a gift or a value trap? Let's find out. Here's our game plan for today. We'll start with how Hotung actually makes money. It's simpler than you think, but has one very important quirk. Then we'll look at 5 years of financials the portfolio companies are betting on, and what makes this fund genuinely hard to replicate. We'll cover the risks honestly, including some forensic flags, before getting to the valuation and RJC fund verdict. Let's go. Hotung is a listed closed-end venture capital fund. Think Berkshire Hathaway meets Silicon Valley VC, but listed in Singapore. Here's the 4-step model. Step 1, raise. Hotung listed on SGX back in 1989. It has a permanent capital structure. Unlike a normal VC fund, investors can't demand their money back. That's actually a superpower. It means the managers can be truly patient investors. Step 2, invest. They deploy capital into early to growth stage tech startups. Series A through C, primarily in Taiwan, the US, and Israel. Think semiconductors, AI, networking, biomedical. Step 3, nurture. This is where Hotung earns its edge. They take board seats. They make introductions. And they have, I'll come back to this, an absolutely elite network. Step 4, exit. Eventually, portfolio companies go public or get acquired. Hotung books the gain. That's their primary value creation. Now, the quirk I mentioned. Their reported earnings are extremely volatile because they use something called FVPL accounting, fair value through profit or loss. Every quarter, they mark their unquoted investments to estimated fair value. When valuations go up, big profit. When they go down, big loss. It has nothing to do with cash. In FY 2025, total revenue was 444 million new Taiwan dollars, but 305 million new Taiwan dollars of that was paper fair value gains. The real recurring cash income, dividends from portfolio companies and interest, was about 172 million new Taiwan dollars. Keep that in mind when you look at their headline numbers. Let's look at 5 years of financials. You can see revenue spiked massively in FY 2021. That was a tech boom, massive fair value markups on the portfolio. Then it moderated as the cycle turned. FY 2025 came in at 445 million new Taiwan dollars revenue, 200 million new Taiwan dollars net profit attributable to shareholders. But here's what actually matters for a fund like this, not the income statement. It's the balance sheet and the NAV. Total assets, 6.45 billion new Taiwan dollars. Investment portfolio, 4.3 billion new Taiwan dollars. Cash and short-term investments, 2.1 billion new Taiwan dollars. That's a lot of dry powder. NAV per share, their estimated book value, is around 79 new Taiwan dollars, which translates to roughly 2 Singapore dollars and 44 cents at current exchange rates. And they've been paying 2 new Taiwan dollars and 55 cents per share in dividends for 4 straight years. Rock solid in local currency terms. The FI 2025 numbers show a business that is generating cash, growing its portfolio value, and maintaining its dividend. Not flashy, but quietly compounding. Now, let's open a hood and look at what they actually own. The portfolio is roughly 38% semiconductors, 25% AI and software, 15% biomedical, 14% networking, 8% other tech. 5 companies I want to highlight. Rivos. This was their big recent win. Rivos was an AI chip startup. It was acquired by Meta. Yes, that Meta. Hotung had invested at Series A. That exit was a major catalyst. Tahoe, another exit in 2025. Data center SaaS company that went through an IPO process. Hotung realized meaningful gains here. DriveNets, this is the one I'm watching most closely. Israeli company building network cloud software. Think virtualizing telco infrastructure. Still in portfolio, Series C stage. A potential IPO here could be worth 400 million new Taiwan dollars plus in realized gains for Hotung. Linker Vision, Taiwan AI vision inspection company. Early stage. High risk, high potential in the AI manufacturing boom. UBG, ultra broadband gateway technology. More mature, steady cash generation. Now, one important note. 70% of this portfolio is what accountants call level 3 assets, meaning they're unquoted, and the valuation is management's estimate. I'll come back to what that means for risk. KPMG does audit the accounts, but you should know the number is an estimate, not a traded price. Geography is interesting here. The existing portfolio is heavily Taiwan, about 52%, reflecting Holdings' roots and their deep semiconductor network. But look at the 2025 new investments. They're shifting. U.S. is now 42% of new deals. Israel is 15%. Taiwan dropped to 35% of new money deployed. That's a deliberate strategic pivot. They're following the AI and deep tech capital flows into Silicon Valley and Tel Aviv. This matters because it reduces Taiwan geopolitical concentration over time, which I consider material positive for long-term investors. So what makes Hotung genuinely hard to replicate? For moats, first, the network. 35 years of relationships with Taiwan's semiconductor elite. Top founders call Hotung. You can't buy that. Second, and this is the big one, Dr. Rick Tsai. He is Holdings investment advisor, former CEO of TSMC, the world's most important semiconductor company, current vice chairman and CEO of MediaTek. The man has a Rolodex that opens doors no fund manager on SGX could ever access. When Hotung looks at a chip startup, they get to run it by the architect of modern semiconductor manufacturing. That's a genuine edge. Third, listed VC in a niche market. Hotung is the only SGX-listed fund with this profile. You get Taiwan deep tech VC exposure with daily stock market liquidity. No lockup, no accredited investor requirements. Fourth, permanent capital. They never have to sell at the wrong time because of investor redemptions. Pure long-term compounding. Put those four together and you have a genuinely defensible competitive position. Okay, the big question. 1 Singapore dollar and 45 cents share price versus 2 Singapore dollars and 44 cents NAV. 41% discount. Why? For reasons. 1, level 3 opacity. If 70% of the portfolio is management estimates, the market applies a haircut. Fair. 2, currency drag. Holding reports in TWD. Singapore investors get TWD returns converted to SGD. The Taiwan dollar has been weakening. Every time it drops, NAV in SGD terms drops, even if the underlying assets didn't. 3, low visibility. This is a small SGX-listed company with minimal analyst coverage. The market simply doesn't know about it. For the market is pricing zero growth. Our reverse DCF shows that at 1 Singapore dollar and 45 cents, your implied portfolio never grows in real terms. Given recent exits above carry, Rivos to Meta Tahoe, that seems very pessimistic. The discount is real. The question is whether it's permanent or temporary. My view, it's structural but compressible, especially if DriveNets delivers. The dividend story looks scary at first glance. DPS in SGD terms fell from S-cent 24.4 in 2021 to S-cent 10.4 in 2025. That's a 57% cut. Alarming, right? Wrong frame. Look at it in NT dollar. Flat at 2 new Taiwan dollars and 55 cents for 4 consecutive years. The apparent cut is almost entirely currency. TWD weakened against SGD. So your SGD check got smaller, but the underlying payout didn't change. The fundamentals here are solid. FCF payout ratio, 60%, well below my 85% red flag threshold. Dividend cover, 1.7 times. Cash on the balance sheet, 2.1 billion new Taiwan dollars. That's 8+ years of dividends just sitting in cash. At 1 Singapore dollar and 45 cents, you're collecting 7.2% while you wait for the discount to compress. That's a paid-to-wait situation. Let's be honest about what can go wrong. Taiwan's straight geopolitical risk. This is high. I apply what I call a geopolitical tripwire rule. Because 52% of the portfolio is in Taiwan, I limit this to half the normal position size. Cross-strait tensions could trigger a sharp re-rating. Level 3 asset opacity, also high. If management's fair value estimates prove optimistic, NAV could reset materially lower. The Tejo and Rivo's exits came in above carry. That's positive evidence. But it's still a risk. Currency risk medium. Every 5% TWD/SGD move is roughly a 5% NAV impact in SGD terms. If you're a Singapore-based investor, you're running TWD exposure. Key person risk medium. Dr. Rick Tsai is the edge. If he steps back, that deal flow advantage diminishes. No succession plan disclosed. Exit timing medium. VC exits depend on IPO windows. If tech markets close, realizations delay by years. Illiquidity, low risk but real. Average daily trading volume is about 200,000 Singapore dollars. You can't move large positions quickly. I put every company through what I call a forensic screen. Here's what I found. 3 amber flags, no red flags. Flag 1, level 3 valuation circularity. Management sets the marks. KPMG audits. But the assumptions are opaque. Mitigant. Both recent exits came in above carry. Flag 2. CEO incentive structure. The CEO is entitled to 1.5% of audited profit after tax as a performance bonus. That's 3 million new Taiwan dollars on 200 million new Taiwan dollars profit. Immaterial. But it does create a small incentive to push fair values up. It's disclosed and audited, so I'm comfortable but watching. Flag 3. 179 million new Taiwan dollars deferred tax liability. About 104 million new Taiwan dollars of this is withholding tax on undistributed earnings, a real future cash cost. It reduces true NAV by roughly 1 new Taiwan dollar and 10 cents per share, already partially reflected in book value, but worth knowing. Net assessment. Governance is adequate, not best in class, but no deal breakers. How does holding compare to peers? Listed VC and investment holding companies globally trade at wide discounts to NAV. That's normal. But holding at 0.6 times price to book is the deepest discount in the peer group, more unusually. It's also offering the highest dividend yield at 7.2%. Most VC funds pay nothing. The closest comparable Rand Capital in the U.S. trades at 0.9 times book and yields 6.8%. Holding is cheaper on both metrics with arguably better deal flow access. The market is not giving holding credit for its network advantage. That's the opportunity. EPS forecasts for a VC fund are inherently uncertain. They depend on when exits happen and what the macro environment does. Base case. I model EPS growing from 2 new Taiwan dollars and 11 cents in FI 2025 to 4 new Taiwan dollars and 60 cents by FI 2030. That assumes DriveNet's exits in 2026 to 27, continued AI portfolio markups, and gradual deployment of the 2.1 billion new Taiwan dollars cash pile. Bear case assumes no major exits, moderate write-downs, and TWD weakness continuing. EPS stays around 3 new Taiwan dollars by 2030. The key catalyst to watch is DriveNet's. That single exit could add 400 million new Taiwan dollars, plus the earnings in the year it happens. Roughly 4 new Taiwan dollars and 20 cents in EPS. A one-off but material. 3 methods of valuation, all converging above 1 Singapore dollar and 45 cents. NAV method, the primary method for close-end funds. Apply a 25% structural discount to stated NAV for level 3 opacity and currency risk. You get a fair value range of 1 Singapore dollar and 80 cents to 2 Singapore dollars. Owner earnings DCF. Strip out FVPL noise. Normalize the real cash earnings of 180 million new Taiwan dollars per year. Grow at 8% for 5 years. Terminal 3%. Discount at 10%. Fair value 1 Singapore dollar and 55 cents to 1 Singapore dollar and 85 cents. Blended intrinsic value 60% weight to NAV, 40% to DCF. 1 Singapore dollar and 70 cents to 1 Singapore dollar and 95 cents. That implies 17 to 34% upside from 1 Singapore dollar and 45 cents before dividends. And the reverse DCF? At 1 Singapore dollar and 45 cents, the market is implying zero perpetual growth. That's the market pricing in a permanent disaster. Given Meta acquired Rivos and Tejo exited, that's not the base case. Our JC fund verdict. Conditional buy. Engine A selection. Dividend income with NAV appreciation optionality. Maximum 3% portfolio weight because of the geopolitical tripwire. 3 entry zones. Entry 1, 1 Singapore dollar and 20 cents to 1 Singapore dollar and 35 cents. That a 45% plus NAV discount. Extreme value. Set a GTC limit order there. If it hits, go to 50% of your intended position. Entry 2, 1 Singapore dollar and 35 cents to 1 Singapore dollar and 55 cents. This is a current zone. Initiate a starter position with high conviction on the dividend income alone. Entry 3, 1 Singapore dollar and 55 cents to 1 Singapore dollar and 75 cents. Add more on confirmed DriveNet's IPO news or meaningful discount compression. Stop loss. 1 Singapore dollar and 10 cents. That's a 50% plus NAV discount signaling something is structurally broken. 18-month price target. 1 Singapore dollar and 90 cents. Assumes discount narrows from 41% to 25%. If I got 5 minutes with Hotung CEO, here's what I'd ask. 1. What is the concrete plan to close the NAV discount? 2. What's the timeline and exit valuation for DriveNets? 3. Would you commission an independent level 3 valuation? 4. What's the succession plan for Dr. Tsai's role? 5. Why aren't you buying back stock at a 41% discount with 2.1 billion new Taiwan dollars in cash? Those 5 questions would tell me almost everything I need to know about whether this is a great investment or just a cheap one. Quick scorecard. Business model clarity. 7. Financial health. 8. Competitive moat. 8. Valuation attractiveness. 9. Geopolitical risk. 5. Governance transparency. 6. Overall JC fund score. 7.1 out of 10. Conditional buy. Small position. Patient holding period. Let the dividend pay you while you wait. That's Hotung. If this was useful, smash the like button and subscribe. It is free. I publish a new deep dive every week. Drop your questions in the comments. I read every single one. See you in the next video. You don't want to miss it. See you then.